evening. Welcome to Trader Central. Hello, can you all hear me? My name is Raja Venkatraman and I am about to present to you the webinar. We are awaiting some more participants out there. So kindly give me 2 to 3 minutes. Could you all confirm to me whether the audio and the video feed is in order? You could type in on the chat box. Okay, is the video all right, right? Great. Okay. Welcome once again to yet another webinar from Growth Avenues. Growth Avenues conducts these webinars titled Technical Analysis for Profits. Technical analysis is a very vast subject, and it's quite interesting to know that there are many facets of technical analysis which we sometimes tend to ignore as we start our trading and investing journey. So, this is an endeavor from Growth Avenues to ensure that you stay in touch with the subject, and for people who are new out there, will get to know as to how the subject really works and what is the power of this subject. All these aspects are covered as part of this webinar, and we'll also highlight to you the various ways in which we present to you this subject and how you can profit from market participation. Okay, market was in a phase of consolidation, and right now we see that it's heading higher and almost challenging 8,000 levels. But how many of you really participated and profited from it? The ultimate key to unlock your profit potential is participation. However, we must admit that even the experienced trader who has developed an understanding of the charts will admit that it's a very subjective art of chart trading. However, in hindsight, you'll always say it was good. Nifty was looking a clear buy at 7,800. But the question is, did you really go for it? Or were you just waiting for a good level, a so-called good level as they say? So the ideal way to approach the market is to arrive at some kind of reference points from where we could take a cue and participate. Why I'm stressing on the word participate is the that is one of the key actions which we need to take instead of just waiting around the corner to find out whether we should be really buying a stock or selling a stock. Under the umbrella of technical analysis, there are many indicators which are available today, and they all work in various ways, in various capacities based on their construct. And today we are going to consider an indicator called moving averages. Moving averages is quite popular, and it's been used by many traders around the world because it's quite easy to follow. So today we'll be saying how a moving average works, how to apply it, and how it gives us a good emphasis and good cue on the market sentiment so that we could take this as an indicator and use it in our trading schedule. But mind you, no indicator is a holy grail. We have not come across any such indicator which can be used independently and you can take profit all the way to the bank. Eventually, the indicators need some kind of discretion, which needs to be applied. So this discretion is enabled through technical analysis. So going forward, I would like you to be aware of that fact, and also you should consider that too much, too many indicators also will cause problem. It's like having too many things on your plate, and eventually your plate falls down. For those who are new to our webinar, I would like to give you a glimpse of this company called Growth Avenues. We are into capital markets for a very long time, and it's a capital market company, advisory company founded by Dr. C.K. Narayan, who is one of the topmost technical analysts in the country today. You can also say that he has pioneered the subject of technical analysis since 1985, where technical analysis of the subject was relatively unknown. He has built the company from a two-member organization to a 20-member organization. We are a technical analyst house. Probably very few would have a full-fledged office where there is active analysis, active trading, and active investment going on at Mumbai. We have advisory services in Growth Avenues for the HNIs. We have training and certification for traders and investors, where we train them into financial markets. We have our own market analytic techniques where we tell you how to approach the market, how to participate using various sets of technical analysis tools. We have trader mentoring programs where we train you to be a trader. We all want to be a trader, right? But how many of us can get the kind of wisdom required to ensure that you are participating at the right time, you're able to spot opportunities in the right manner? All this is covered under our trader mentoring programs. And for those who wish to participate but are unable to do so because of their other commitments, you could leave it to the experts. You could park your funds in our discretionary management trading accounts and ensure that you are able to participate at all times in the market, where Dr. Narayan himself manages a fund and he trades your funds for you. So let's get right into our subject of the day: how to apply moving averages. Well, we all know what are moving averages, or we all have heard of moving averages. But today I'll show you some ways in which you can understand the concept of moving averages and how is it applied. Well, there are three stages of a trader, and this is the way we all like to progress. The first one you can see is where we trade with individual instincts. We have the gut feel, so to say. We feel, wow, this is the right time to buy. Oh, this is the right time to sell. Or maybe let's stay away. So these are all gut feels. And gut feel trading has its own pitfalls. And one must accept it as you go along, because it has got its own limitations, it has got its own plus. But at the end of the day, trading with individual instincts will only take you thus far. For this, you need deep capital, which is not available with many people. The second type of trader is trading with methods. We need methods to participate in the market, and methods are not easily available. You need to apply yourself diligently in the market. You need to understand some subjects and develop a method so that you can participate in the market. So moving average is one such indicator which shows you that whether the time is right to buy or the time is right to sell. Similarly, There are other tools like Fibonacci. There are other oscillators which are available. So these are all methods which are there in the market, which one can use to trade. And it helps you de-skill the process of gut feel. And it helps you be calm, keep your emotions at bay, and ensure that you're participating in the market at all times. And the more evolved or the more advanced traders are those who develop their own proprietary trading system, and you can reach that level only when you pass through the method B, which is trading through some methods which are developed using technical analysis tools. So thus I've shown you method A is trading with your instincts, stage B is trading with methods, and the last evolution of a trader would be trading with proprietary systems developed and enhanced over the what methods you have used in your stage B as your proprietary own systems which you use to participate and profit. So before we go into the concept of moving averages, let me give you a glimpse of how on what is the moving average applied. Moving average is an indicator which is giving you an indication of trend. Before we understand moving average, we should know what is a trend. Trend is a movement of price forming a higher high or lower high, so that you know that the prices are attempting to move in some direction. What is the direction is determined by the higher peaks which it forms. You can see here, this is peak 1, this is peak 2. So peak 2 is higher than peak 1, which indicates that the prices are in an uptrend. Similarly, when the prices are moving down, you have the peak 1 here and you have the peak 2 here, which says that the peak 2 is lower than the peak 1, which says that the prices are in a downtrend. So this way you get to know that the prices are trending either up or down. And trends, depending on the time frame, it is divided into either a short term or a medium term or a long term. And when prices do not trend, it's called a sideways or consolidation. Actually, in technical analysis, there are only two trends, either it's uptrend or downtrend. There is no sideways trend. Here I have mentioned it just for your clarity, but otherwise in technical analysis there is only uptrend or downtrend. Technical analysis is built on the assumption that prices trend, so that the tools which are designed in technical analysis are able to aid you in your decision making. And trends are an important concept of understanding line studies, of which moving averages is a part of the line studies family. Alright, any questions so far? Any questions, please type into the chat box and I'll be happy to clarify the same. Okay, now then what are moving averages? Moving averages is the most common and widely used indicator, like I mentioned earlier. It can either be a it's a trend following indicator because it is based on the past prices. It's always on the history. Moving averages is a calculated or a derived indicator. It is based on the price points which are there as part of your price which is available at any point in time. What moving average does is it it smoothens or it normalizes the movement of the prices, so that you get an average of the price history of which you have considered, and enable you to understand what's going to happen when prices move up or down the moving average so that you can take suitable action. About the action part, we will come to it in a few minutes. You can see here, this is how a moving average looks. As soon as prices start trending lower, you can see that the selling pressure increases. So I'd now like to give you a glimpse of our technical analysis program. I've been talking about technical analysis, and who better than Dr. Narayan to give you an understanding of technical analysis? With his more than 37 years of market experience, he has summarized his entire wisdom into a webcast, which has begun from which already finished several rounds, and we have a time window concept where from January 1st to March 31st, you'll be able to view the recordings of our technical analysis webcast. What we do in this webcast is we capture all the topics of technical analysis, and we have a video of Dr. Narayan where we feature all the concept. The advantage of this webcast is that the recording is available with you. You can view it n number of times for a period of 3 months. The validity is for 3 months, and within those 3 months, we'll be having a session by Dr. Narayan himself where we will have a live webinar where he will put together the all the technical analysis concepts. Then there will be a support webinar where we will teach you how to use the various tools of technical analysis on the recent market so that your understanding of the subject goes up much higher. And at the end of the 3 months, you'll become a very confident trader. And since this entire webinar is available to you n number of times, you can actually open the chart and see all these topics like support resistance, Dow theory, candlesticks and patterns, the traditional price patterns. Then there are line studies, which I mentioned, channel, pitchfork. Then there are Fibonacci techniques, which is a mathematical relationship of price movement. Then what I'm covering today, moving averages, that will also be covered in detail. And then there are oscillators, which are covered in detail because oscillators give you the movement of the price that's also derived from the prices, and it gives you a good lead on what the price is actually going to do. So even that is covered in detail. And then the entire construct of technical analysis are put together in the last webinar where you'll get to know on how the entire thing should be used to analyze the market sentiment. So I'm very sure that you would have seen technical analysis programs or maybe attended a few as well. But I'm very sure that nowhere you would have got a 25-hour technical analysis program. A 25-hour technical analysis program where he you get to know why technical analysis is important, how price is an influencer of all decision making in technical analysis, and how it has to be studied, and eventually how it has to be applied. So all these four parameters are considered in our CTA webcast, and all this is available to you for a modest price of 17,000, and for the details of which are available at our office. You could call our office for more details and get hold of this webcast in case you are planning to get into technical analysis. There'll be no other webcast which will be so detailed as this. But why would you want to do a CTA webinar? A, it's quite structured because it tells you what is necessary and how the whole thing is built up. We do not directly show you a price pattern. We actually tell you why a technical analysis study should be done, how prices are important as part of technical analysis, and that way your understanding is built over the period of 25 hours to ensure that your understanding improves. And it's done by the man himself, Dr. Narayan, so that you do not have to go anywhere else. You have the person who founded the technical analysis in India, who has received the Lifetime Achievement Award from ATMA for his contribution to technical analysis. ATMA is a body of technical analysis in India, Association of Technical Market Analysts. You can look it up on the net, and it gives you complete clarity, just like the picture shown here. You can see each structure independently, and you can define the contours of how you would like to go in the subject. And eventually, at the end of the day, you need a structure that will hold your understanding of the market, hold your basic decision making in the market for a long, long time. So, when you consider all these aspects, the investment which you will make of 17,000 will be recovered very quickly, because our entire subject is focused on giving you the right amount of knowledge to so that you are able to participate in the market immediately. And why a growth avenues webinar? Value for money, fantastic technical support. We have live chat to solve any of your queries, and all our webcasts are viewable in any of the devices. Eventually, we all want to ensure that our investment is worth every penny, and we guarantee you that at every point in time, because innovation is the foundation of excellence, and Dr. Narayan believes that we continuously have to keep innovating, and this is one such innovation from us. Okay, moving on to moving averages. Matching, isn't it? Moving on to moving averages. So some questions will be whether it's available in all softwares. The answer is yes. It's available in all softwares because it's a very widely popular tool which is used by many traders. And why people use moving averages is it's uh, very useful for trading, as it shows very timely entry and exit. We'll get to see now how it's possible. Moving averages are constructed using the price points. And what are the price points, if one would like to know, is there are 4 data points for every price, which is open, high, low, and close. Ideally, moving averages are drawn on the close. However, there are other ways to draw moving averages, which I'll be showing you in the upcoming slides. The two most commonly used moving averages are simple moving average and exponential moving average. So these are the two types of moving averages which are there in your software, and it can be used for plotting. So when you move on to the application part, now I'll be telling you how to use the moving average. We all know moving averages are plotted on the prices, and they are working on crossovers. So when you want to know about crossover, crossover means when a price moves above the moving average or when a price moves below the moving average. So when does the price move above the moving average? When there is a buying pressure and it eventually propels the price above the moving average. Similarly, when there is a pressure on the downside, when the price pushes the when the pressure pushes the price lower, then it creates the a sell trigger. So trading signal, which is referring to a trading, the way to trade the market or the way to trade a particular security, like the word signal says, is it okay to buy or is it okay to sell? That is a signal. And a trading signal is one where you take an action. So a trading signal is divided into two parts. The first, like I have shown here, it's called a trigger. You can see this is a trigger. So when you are referring to a trigger, this is where the prices have closed up. So you could actually take a buy above the high of this, which is here. Once the prices move above this, it's a trigger. This is a trigger because you are now ready to buy. It's okay to buy. And but the prices do not go above this. Instead, the prices are actually coming down. The same chart is there on the downside. You can see here that again the prices headed lower and it formed a negative trigger, and then the prices moved lower, resulting in a sell trade. We were actually looking for a buy, but that didn't happen, and the prices reversed from there on. So here we had the trigger, the prices don't move up, so you didn't have a trade. So trigger and trade together forms a trading signal. So we only had the trigger in the top chart, and the same chart which is shown down, the trigger reversed and it formed a sell trigger. We were looking for a buy trigger, the buy trigger reversed to form a sell trigger, and then you had a trade as well. Is it clear now? Any questions on this particular understanding of a trading signal? This is how a trading signal works in moving average. If any query, please let me know. Okay, so this is how a trading signal gets set up in a moving average. So some of you may be wondering whether you could profit from technical analysis regularly. Yes, of course. This is a chart with the simple moving average. You can see here it's a single moving average which is drawn, and the red arrows shown here are the selling points. You had this red as the sell trigger, and this is a sell trade, the sell trigger and the sell trade, and then here you have the buy trigger. There's a buy trade. Here is a buy trigger and there's a buy trade. Again there is a buy trigger but not much action, and again there is a buy trigger here and there is a buy trade. Again there is a buy trigger and there is a buy trade, and again there is a buy trigger here and the prices are moving up. So this is the way to use moving averages. You can choose the time frame you would like to and participate. The higher the time frame, the more delayed the signal will be. The lower the time frame, the more faster the signal will be. So you'll have to find out your trading style, what is your trading mindset, and ensure that you are able to have a frequency in which you will be comfortable. Instead of, you can also trade in a 5 minute, but then you will be having so many signals that either you won't have capital or you won't have patience. So we'll have to manage both, right? So that's why I'm saying that we'll have to find out the ideal time frame which will ensure that we are able to participate in the market at all times. So I have identified some rules for you so that you could get an understanding of how to work it out. When you're going for a buy, you'll have to wait for the price to rise above the moving average and form the trigger. Then wait for the price to trade above the trigger for your trade. In such a case, your stop loss would be below the moving average. Then rising, as price starts rising, your stop losses also keep moving higher. See here, in case you have taken this buy, your stop losses keep moving higher. So in this case, you would have entered here, you would have exited here. So this is your profit. So this is the way you got to trade. And here, once you sell here, then your stop loss would have got triggered here. Again, you will sell here. Then there's another sell opportunity here. So multiple sells eventually, even if you had exited at this point, you would have been able to encash this whole move, which is close to some 30 points. So you'll have to, and your stop losses, they keep on moving lower. So this is the way to trade with a single moving average. It can be either simple or exponential. I have taken simple. The same way is on the way down. Wait for the price to fall below the moving average and then form the trigger, and then wait for the price to trade beneath the trigger for the trade. Now, there are other ways to trade using the moving averages. The other method which I am showing you is a double moving average crossover. You can see here there is a blue line which is running through, which is the shorter term moving average. I have highlighted it for you, and you can see here the red line, which is the longer term moving average. So since it is a shorter term, there is more oscillation and it is more close to the price than the longer term moving average. So how to trade such a moving averages? So these are the rules for buy. You wait for the price to rise above the smaller term moving average, and then keep your stop loss below the longer term moving average. So in case take this trade here, the stop loss will be here, and then it will keep following and get exited here. So what happens in such a case is, in such scenario you will never enter. It's come but it didn't go below this, so you will not enter. Is this method clear? Any questions on this method? And for exiting, you could choose your ATR method, or you could use your range method, range of the stock for the day, and exit the trade. For sell, again you go in a similar manner. You could see here there are several entry points, and by using a shorter term moving average, you are actually avoiding entering when there are particularly no signals. So you wait for the price to trade below the shorter term moving average, and then you take the signal. If one can see at this place, here the shorter term moving average had not come down. It came down in this particular bar, and prices didn't move below this. So it avoids you from getting into a trade. And here you can see every pullback you got a buy opportunity here. Okay, here it shows you it went up, then it came down. A pullback to the shorter term moving average can be considered as a buying opportunity, and then again it went up. there's a pullback, and then there's a gain. So every pullback to the shorter term moving average can be used as a buying opportunity, and you could continue to trade as long as the longer term moving average stop loss is not broken. So this way you can ensure that you are able to participate in the markets, and both the moving averages are based on the close. Well, I definitely told you that there are other ways to apply moving averages, and I would come to it now. And as I go along, I'd like to highlight to you another interesting webinar which is coming up. It's a live webinar. Earlier, I had told you about a webcast, and this is a live webinar where Dr. Narayan will be taking on how to trade the indices. With so much volatility in the market and the increase in lot sizes, there is active interest in the index trading. Index has been quite popular. People with limited capital always prefer to trade the index because there is more liquidity. So we have a webinar which is designed only for trading the index, where the Nifty behavior is discussed, the Nifty volatility is discussed, how to address the Nifty and Bank Nifty with our own proprietary methods. Mind you, nobody in the market today shares with you their own proprietary methods. Dr. Narayan believes that we have learned from foreign authors, we have learned from Indian authors, and there is no harm in sharing, because eventually the knowledge spreads by sharing. And that's why Growth Avenues today is probably the only institute that conducts such webinars where actually you learn. Though we have titled it as a free webinar, you actually end up learning, or you end up brushing up your technical analysis basics, and maybe try to apply it in a different way. So that's why Growth Avenues is a very, very different organization, and associating with us always ensures that you're on the right side of the market and you're on the profitable side of the market. Well, going to this webinar, going to this webinar, it's going to be conducted on 12th and 13th February, where Dr. Narayan will showcase you methods like what I have shown you, and more strategic and more focused methods. And he will be telling you the buy sell rules, and he'll be showing you many charts which shows you the potential of that method and how to analyze the same. He will tell you how to set the stop losses. These are all methods which we apply in uh, on day-to-day basis in our advisory for our HNIs, as well as we advisory on our fund management. We use these methods and spot opportunities well before the market gets into it. And that's not all. We have a fantastic support webinar system, a very unique, again, a very unique concept from Growth Avenues, where we tell you how these methods could have been worked and how you could have profited, and thereby we actually help you understand this method much, much better. Well, what do we want at the end of the day? We want profits, right? Do you want profit for a day? Do you want profit for a month? Or do you want to be a profitable trader year after year? That is what you need to address. If you want to be a profitable trader year after year, then you need to have methods that will stand the test of time. And for those kind of methods, we are a house which has got a lot of interesting methods, and we are willing to share it with them, share it with the users, share it with the participants. And the fee for this program is only 6,000, and for 6,000 you get four webinars. The 12th and 13th February is the date for the upcoming webinar. You could register on our website, get to know more details about the program, and then we also have the support webinars which will follow up after this session and ensure that you are a profitable trader. Well, we go on to the other kind of moving averages. You saw the moving averages which are on the close. I'll again go back to those. You could see here it's a single line which says that it's drawn on the close. And like I mentioned to you earlier, moving averages can be drawn on the high, low, open, and close. So this is a banded moving average. You can see here there are different ways to trade it, and these are discussed in our training programs. In our webinar, you'll get to know more about banded moving averages. And then there are variants like banded moving averages with filter, where again we'll tell you how this filter works, how it has to be set, what are the rules for the filter. Everything is discussed to give you a concept of how effective it can be to ensure that you are participating at the right time, at the right moment, and at the right spot. Then there are moving averages ribbon, which tell you how to trade the market in a very different way. These are higher level concepts of moving averages. Moving averages we all think is just a line, a wavy line which goes across the price. But there's more to moving averages than just a line which flows through the price. There are varying concepts to it. There are various intricacies to it, which are higher levels of studying of moving averages, which we cover in our webinar. For more details on the same, you could call our office and get to know more, or you could call and speak to me on these webinars. Well, moving towards the end of this webinar, we would definitely like to tell you that moving averages is not a holy grail. It's not the perfect indicator. It's not the it's not the final solution to your trading. You need to actually participate, understanding that it'll never get you in at the bottom or it'll exit you at the top. So these are facts which you need to understand. And you should also remember, though it is easy to follow, you should know that when it is the markets are sideways or non-trending, moving averages generates a lot of false signals. So it's always good to know that a indicator is good only to a certain extent, and we should definitely use our discretion when we are using these indicators to participate in the market. So with that, I come to an end of this webinar, and I would like to thank you all for your participation. So I now invite the audience to pose any questions so that I could answer them. We have other 4 to 5 minutes before we conclude this webinar.